Are you an expat? Do you want to make sure that you are tax compliant? If the answer to those questions is yes, then you need to stay tuned for the video because I'm going to tell you how to plan your tax as an expat. Hi, my name is Rusudan. I have been working with Nomad Capitalist for more than 3 years, and we have been helping high net worth individuals legally reduce their tax, get second citizenships, and go where they are treated best. So today's topic is tax planning for expats. To go into detail about this topic, we first need to establish who is an expat. So expat or an expatriate is a person who is working and living outside of their country, home country. So in this case, the purpose of living abroad may be different. It's maybe due to retirement or working there, or maybe just a change in lifestyle, or you just prefer to live in a new country. So it doesn't matter why, but the fact that you are living in another country makes you an expatriate or an expat in short. So now that we have established who this video is for, we now can talk about what it means and what steps you need to take to make sure that you have your tax planned correctly. The first thing that we have to establish is why you need to be thinking about tax. The first reason is you need to stay compliant. You need to make sure that in the country that you live, you are compliant with the tax regulations, you're paying taxes, or if you don't have to pay tax but you have to file certain things, you're following all the requirements there. The other thing that is very important is following these rules may provide you with more financial efficiency and with more wealth that you can accumulate. Because in certain situations, if you go through the whole strategy and plan your tax correctly, you may find certain tax savings that you can then allocate to other purposes. So it's very important to go through this, because when you are dealing with different countries, there are different exemptions or regimes that you can apply for, and you can reduce your tax bill significantly. One other reason that it's important to really plan your tax instead of just following through or not even thinking about it, double taxation agreements that countries sign between each other to make sure that the same source income is not taxed in two jurisdictions. Not every country has that, of course, but if your countries, so your home country and your current residence country, have this agreement, it means that you can make sure that you pay tax only in one country, or you're just getting a refund in another country. It can work in a different way, but basically it gives you opportunity to pay tax only in one country, thus making sure that your tax bill is as low as it can go. So the first thing that you need to establish is where is your tax residence, and be clear that your tax residence and residence can be different. We are going to be talking about only tax residence, and in most situations, a tax residence is defined by different tests. Lots of countries measure it. If you stay there for 183 days, you automatically become a tax resident, so you are obligated to pay tax in that country. So, for example, let's say you're a person who has been living in Portugal, if you're a Spanish citizen, but you live in Portugal for more than 183 days, it means that you have to pay tax in Portugal. Now, it doesn't mean automatically that you don't have to pay tax in Spain. With no planning, you may be required to pay tax in two countries. But if you plan correctly, you may find a way where you just pay in one country, or you just get a refund in another country. So there are different ways to do it, but you need to have a strategy for that. The most common way to measure, to determine tax residency, as we said, is physical presence test. You may not be spending 6 months in that country, but you may have family, you may have a business, you may have bank accounts, you may have properties and physical assets there. So some countries define it with the connection that you have to this country. And also you have a domicile test as well. So there are different ways countries decide and make a decision about your tax residency, but if you become a tax resident, the result is the same in every country. You have to pay tax there. So again, it doesn't automatically mean that you don't have to pay in your home country, but it means now that you have to look into the ways to reduce your tax bill in one of those countries at the very least. One way to do that is to see if there is a double taxation agreement. So these are the agreements between countries, as we said, where the countries agree that for each specific income, one of those countries will have you pay tax for. And this is usually a very detailed agreement. They define it can be an income, it can be like a salary, dividend, business income, royalty, different types of income that you can gain from different activities. And they define how each of these is taxed in which country, who is collecting money. When I have to think about any kind of like taxation, I usually go to the website of the Ministry of Finance of that country, and usually they have this double taxation agreement listed there. So it's, if you're thinking about moving to a certain country right now, I think that's the first thing that you should be doing with the research for tax planning. So for example, like if you are Canadian and you live in Germany, Canada and Germany do have a double taxation agreement. So basically it means that you have a way to reduce your tax bill and pay tax only in one country. One other thing that also helps with tax planning is foreign earned income exclusion. So this is basically some countries, for example US, has a benefit where a taxpayer can, up to a certain amount, do not pay tax on the foreign earned income. So basically if you are a US citizen or a US person, because US pretty much tax everything, it doesn't matter where you earned it, but they do have this exclusion where if you are a US person and you earned something outside of the US, up to the threshold for that year, you do not have to pay tax on that. For example, as of now, at the time of recording this video, the US has $126,500 as the maximum threshold for this amount. So it means that up to that amount, any income that you have earned outside US, you may not pay tax on that. But if you earn more outside of the US, then you have to pay the tax on the difference. But there are other like smaller exclusions or regimes that you can apply in this case. For example, you can have like a foreign tax credit. So if there's some leftover after the foreign earned income exclusion, then you can get credit because you paid something in the other country and you are getting it credited to your US tax bill. One other way to reduce your tax bill and have a better tax plan for you as an expat is maybe some investments, like tax-free investments in some countries. For example, in Singapore, if you like invest in ETFs or like some bonds, the government bonds, then you can exclude those in your taxable income for your home country. So basically, there are certain assets that you can invest in that will give you a tax benefit for your overall annual tax. It's one thing to have a good plan for your taxation as an expat, but there are certain things that you have to think about and certain considerations. The first thing is like it's a new country, it's not your home country, maybe there is a language barrier or something, so it's really important and sometimes a bit difficult to keep up with all the changes there, because you have to be aware of like any tax law changes or any additional requirements that are coming up, and usually they happen. You may not always be watching news for that in the country that you live, right? So it's very important to keep up with that, and one way to do that is to have some kind of a tax advisor or somebody who really informs you about anything that is relevant to your situation. The biggest concern with tax planning for expats is juggling different jurisdictions. So you have your home country and you have your like tax residence country, and the laws and the tax laws between these countries, they are not always very clear, and it's not always very easy to find somebody who knows both jurisdictions. So in most cases, you have to work with two like tax advisors. And the common like phrase that I usually hear from those are like, I know about my country, but I don't know anything about the other one. And then you are in the middle and you have to think about how one works with the other. And that's not always very clear and very easy to determine. So it's very important to have somebody who is going to be looking at a bigger picture and making sure that there is no missed requirement or compliance. Somebody who is going to be thinking instead of you and making sure that these two countries work well together and you are not falling behind with any requirements either of them established for you. And this is not only for expats, but I think that I tell that to everybody, is just keep your records. Like you have to keep your documents, your receipts, like all the things that reflect money movement they need to be reflected and they need to be maintained. Like it can be like a digital copy or it can be a physical copy. It really depends on different countries. But it's not only good for yourself, like you know what's been happening, but it also means that you have proof and an answer to every question that you can be asked. So it's very good to keep that. And it's also very important to keep them organized, because I've seen situations even in companies, like they have all the information, but it's so disorganized that it's very difficult to access. So it's very important to maintain records and maintain records that are easily accessible. Another tip that I would give for this topic is seeking professional help, because, and this is not a selling point, this for tax, it's really important because there are small nuances and usually not tax law is not very clear. There are certain things left to interpretation, and when you're moving to a new country, you don't know how those are interpreted. Like you can have a tax law in a country where it says that there is a clause about something, but it's common practice that they do not use that, or maybe it means it's used in a different way. And those are the nuances that it's very difficult for a non-tax professional to understand, to interpret correctly. So it's very important to find somebody who's going to be knowledgeable about that and who's going to keep you updated on all those changes and new things happening in the country. Or you have somebody who is going to help you with that. And if you need additional help or information, you can go to nomadcapitalist.com and apply now.